to do that at one point and another one. Tonight, we're going to cover foreign-based company sales income and foreign-based company services income. Let's get down to that point and have it sitting there for a moment. These are two key aspects of Subpart F income. And while the two sections of the code are quite short, together they're only about 1.5 pages in my paperback copy, they're very significant, and the regulations on under the two rules are fairly lengthy and sometimes a little hard to understand. So I expect we're going to spend the bulk of the hour covering these two topics. Before we dive into those, though, let's go back to a key thing that I'll probably emphasize several times: why Subpart F exists. If I were a good tax planner before Subpart F, I'd advise my clients to try to stuff as much income as they could in offshore companies where the tax rate was low. If the clients were reputable and I was reputable, we'd put functions and risks into those subsidiaries. If we were just trying to play fast and loose with facts, we might not even do that. Subpart F was designed not to prevent that, but to prevent that causing deferral of U.S. tax. The Subpart F rules came about in 1962, so they've been around a long time. I'm just continually amazed when I encounter people in public practice who don't seem to have gotten the memo from 60 years ago. Subpart F prevents exactly the scenario you see here on the screen, where a U.S. company shifts its profits into a foreign sub, and the profits could be in the form of investment income, of intercompany sales income, or intercompany services income. So Subpart F directly attacks this, and here's what it does. It requires U.S. shareholders, that's a defined term, of controlled foreign corporations, also a defined term, to include in their income as the sub earns it, their share of the Subpart F income, and also if the sub loans it back or otherwise invests in U.S. property, then the amount of E&P of the sub loaned back or invested in U.S. property. The overview video had a brief introduction to Subpart F, and there's an introductory video out there that covers the basics of Subpart F, including the definition of CFCs and what's a U.S. shareholder. Tonight, there are a couple of key parts of Subpart F. The first key prong of it is Subpart F income, and the second is the investment in U.S. property. Subpart F income, back up to this slide, Subpart F income includes some things that we're not going to talk about in this course. I know Anna is with an insurance company, so the foreign-based company insurance income provisions would be of interest to her, but for most of the rest of us, the insurance industry as a special industry just isn't something we're involved in, so we won't be covering that. There is still one item within Subpart F that you may encounter, and that's illegal bribes. Now, bribes, kickbacks, and that sort of thing. For public corporations, you won't encounter this a lot because the Foreign Corrupt Practices Act makes public companies disclose these on their U.S. financial statements and in their 10K. So material amounts of these must be disclosed, and the penalty for failure to disclose is prison time for the CFO. So they tend to be disclosed, and most public companies do what was desired from that provision of the Foreign Corrupt Practices Act and make sure their company doesn't do it, except in trivial amounts. There are some other items of limited application that we won't go into also in Subpart F. So the key thing is foreign base company income. Foreign base company income has 4 parts, 3 of which we'll be covering in the course. Excuse me. Foreign personal holding company income will be covered in a video that I hope to have released sometime late tonight in its very preliminary form. And then by this time next week, should have a much better video on foreign personal holding company income. We're not going to cover foreign-based company oil-related income. If I were teaching this course in Texas or Oklahoma, we would be, but we're in New Jersey, so we just don't encounter it that much. What we're going to cover tonight is the other 2, foreign-based company sales income and foreign-based company services income. Let's get to that point. So let's start in with foreign-based company sales income. This is income of any sort related to buying goods from anyone and selling them to a related party, or buying from a related party and selling them to anyone, of property made, grown, produced, or otherwise from a country other than the CFC's country of incorporation, and for use or disposition outside the CFC's country. This full slide is one sentence in the code, so it's really difficult to get your head around initially. What I want to do is go through the key pieces here to make sure you understand them. And then we'll give some examples. I'm going to ask you guys for examples too. Foreign-based company sales income is from buying and selling or getting commissions. The code is fairly explicit that the type of income is kind of irrelevant. It says income whether in the form of profits, commission, fees, or otherwise. In other words, income regardless of how you got it, derived in connection with purchase and sale. Not making and selling, buying and selling. So let's go through these pieces. Again, I really encourage you to read the code and regs on this. It's critical. So let's go through the pieces of this rule. There are 2 key themes in the 3 parts of Subpart F income that we're discussing in the class. First, a related party is involved. And second, there's something going on outside the CFC's country. So let's go through these bullet points just one by one. Foreign-based company sales income includes buying goods from anyone and selling to a related party. So we can be buying goods from a third party, say made in China, using our Hong Kong subsidiary. And China and Hong Kong are different countries, by the way. So if our Hong Kong subsidiary is buying some clothing from an unrelated manufacturer in China, and then selling it to any company within our worldwide group of companies, then the profits from buying and selling that clothing is subject to Subpart F. By the same token, if we have a subsidiary buying from a related party and selling to anyone, then we have Subpart F. Now, the key aspect here is it's got to be property originating outside the CFC's country and for use or disposition outside the CFC's country. If I've got a China subsidiary buying goods from another China subsidiary and then selling them worldwide to my affiliates, that's not Subpart F, because the goods were made in China where my selling subsidiary resides. So this is a really key aspect of this. We've got to have a related person involved on one end or the other, and the goods have to both originate in and be destined to some other country besides the one the CFC is organized in. Now, as we were talking, mentioned a couple of examples, and I'd like at this point to open it up and have a couple of you, either through the chat function or verbally, I've got the microphones on, and you may need to enable your own. Give me an example of something that you think is Subpart F income on the sales side of it. As we're coming up with the example, Anna says cross-border sale of goods. Yes. Well, give me a specific example. You don't have to tell the client name or the company name, just give me a good example. While you're thinking of them, let me talk about one of the presumptions in the regulations. There's a presumption regarding place of use, and it's based on the destination country. If the CFC sells goods, and I'll get to your insurance question in a moment. If a CFC sells goods and ships them to an unrelated party outside the CFC's country of incorporation, those goods are presumed to be for use or disposition outside the CFC's country. Now, the presumption doesn't apply if a related party is the buyer and the CFC knows or should have known facts otherwise. Now, there are some variations on this within the regulations that it's probably a good thing to read. Anna asked a question about insurance, and foreign-based company insurance income under Section 953 relates to a foreign or a CFC insuring risks outside its home country. There are some fairly complex rules related to that insurance income. And Anna, I'd be happy to talk a little bit about it, but I'm not an insurance guy. Where one type of goods that could be sold is fungible goods, things like wheat or oil. Oil is probably not a good example because oil-related income is a different subsection. If we sell grain or liquid products that you can't tell one bushel of it or 1 gallon of it from another, then those are considered fungible goods. Fungible goods are considered sold in proportion to sales by the first purchaser. So again, a special rule on fungible goods. Now there's some exclusions for foreign-based company sales income. It excludes income from the sale of goods made by the CFC. So foreign-based company sales income is from buying and selling, not from making and selling. Now, how do we tell the difference between making and selling? Well, the regulations have 4 different tests, 3 of which are purely fact-based tests. If our subsidiary is making the goods and selling them, then the income from that is not Subpart F, no matter what country it sells them to. Now, there's an exception we'll get to in a moment. So how do we tell if something's manufactured? 4 possible tests, and meeting any one of these gets us out of Subpart F income. First, the property sold is in effect not the same as the property purchased. The regs are kind of vague on what this means. Clearly, the writers of the regs had something in mind here, but it's hard to tell what it is, especially in view of the next test, that the property has been substantially transformed. I view these 2 as slight variations on the same thing. For instance, if I buy some steel in large bars and I roll it into sheet, then I've substantially transformed it, or it's not in, the property sold is in effect not the same as what was purchased. Steel bars and steel sheeting just really aren't the same. There are loads of other examples that we could do on each of these 2, and you see them commonly in the real world. The third test is the activities conducted are substantial in nature and generally considered to be manufacturing. Often this is pretty easy to figure out what's going on too. If you've got a lot of equipment and a lot of employees doing real things that look like it's making something, then it's considered to be making something. There's actually a court case on this activity substantial in nature and generally considered manufacturing. And it shows how low the threshold is for manufacturing. Bausch & Lomb, the eyeglasses manufacturer, used to have an Irish subsidiary, probably still does. And the Irish subsidiary took lenses that it acquired from a related party, and frames it acquired from a related party, and screws and nose pads that it acquired just on the open market, and assembled those things into sunglasses. Now, if you got a pair of sunglasses around that have several parts, you take them and look at them and you're going to say, that's not very many parts, and it sure doesn't take much to put those together. Well, Bausch & Lomb argued that since they had multiple employees doing this, and it involved tools, some equipment, they needed a little jig to put the sunglasses on while they were screwing the screws in, and some training, that therefore it was manufacturing. And lo and behold, the tax court said, yes, indeed, that is manufacturing. So with Bausch & Lomb, this sunglasses subsidiary that was buying the lenses and frames from related parties and selling to related parties was considered not to be generating Subpart F Income. The Bosch and Lomb case is pretty old, but it's still good law. And the tests of what is manufacturing, as applied in that case, have substantial application in the 263 Cap A area. There was a later case under 263 Cap A. Well, first, a bit of history on this. If you contract out your activities that are manufacturing to an unrelated party, and you maintain certain risks related to the ownership, you have ownership of the inventory at all times, even while the third party is working on it, and do certain other things, that's long been called contract manufacturing. There was a case under 263 Cap A that we'll talk about. The IRS had come out with a ruling in 1997 saying contract manufacturing didn't qualify as manufacturing for this Subpart F test. The ruling was kind of weak, but it was a published ruling, so it was, fight this at your own risk. Lo and behold, in 2000, the IRS took a 263 Cap A case to tax court called Susie's Zoo. In Susie's Zoo, the taxpayer was an S-corp owned by a cartoonist who wrote the cartoons Susie's Zoo, wrote and drew. Her corporation also sold party favors, napkins, all sorts of printed stuff. And 263 Cap A requires that a manufacturer capitalize certain costs. Susie's Zoo was not doing that. They had a contract manufacturer, but Susie's Zoo owned the materials and the designs and everything throughout the process. This printer was simply doing a printing service. Well, IRS, foolishly I think, argued the Susie's Zoo case that Susie's Zoo ought to capitalize the costs under 263 Cap A because they were a manufacturer. And they won. Of course, that instantly shot down any arguments that contract manufacturing doesn't work in Subpart F. So, foreign-based company sales income does not include manufacturing income, even if you have contract manufacturing by somebody else, as long as you do it right. Let me look at the question. There was a question now that's very much on point to what we're talking about right now. A Romanian CFC buys flip-flops from a China affiliate and sells them to a Hungarian related party. So we have a Romanian company buying from somebody goods produced outside Romania and selling them outside Romania to a related party. If there's a related party there, either side of it, then that's Subpart F income. Now I've twisted the question to get at my own purposes there. The question was, how about if it's buying from an unrelated, this was buying from a China affiliate and selling to an unrelated party. So this is clearly Subpart F income in this question. There's an exception to this buying and selling called the branch rule. And before we get to talking about the branch rule, I think some background on non-US law may be very helpful for you. Foreign law often recognizes a branch of a company as if it were a separate company. this is extremely common under European civil law countries, France, Germany, Italy, Spain, etc. It's also fairly common in Asia that Company A has a branch, or Company A is incorporated in, say, France, has a branch in the Cayman Islands, and the French government doesn't tax the branch income from the Caymans until the branch sends it back to France. U.S. rules say a branch doesn't exist. It's a nothing. But foreign rules often say a branch is almost the same as a subsidiary. Now, recognizing that, there's this branch rule. But again, before we get to the branch rule, let's take another quick detour. I've posted a video out there that so far very few people have watched on disregarded entities. I really recommend watching that video. It's only about 10 minutes. If a person owns all of another entity that is not treated per se as a corporation, and that then that entity may be disregarded as separate from that person. So if we have a CFC that owns 100% of a company in another country and makes what's called a check the box election, that I'm sure you're all familiar with, then that company in the other country is treated as a branch. This branch rule is just about the only place in U.S. tax law where that disregarded entity, or even an unincorporated branch, is treated as something besides non-existent. One other place is something we'll talk about briefly in the foreign exchange rules. So if we have a branch of our CFC, and the CFC and the branch are involved in buying and selling goods, or the CFC is making goods and selling them through the branch, or making them in the branch and selling them through the CFC, then we have a potential for this branch being treated as existing and as if it were a separate CFC. I'm going to quote you something from Jim Tobin, who was head of international tax at Ernst & Young for quite a few years. And he wrote this in an article. He said, "I suppose I should be embarrassed to admit it, but almost every time over the years that I've had to deal with the Subpart F sales or manufacturing branch rules, I've had to open the regulations and read through the rules yet again to get myself back up to speed on the details. And in the case of these branch rules, as much as anything, the devil really is in the details." His article was about some modifications to those rules, and he went on to moan about those. But the branch rules are intellectually difficult, and everything is in the details. So let's go over what this branch rule does. If we have a buying, selling, or manufacturing branch, it's treated as if it were a separate CFC if there are two things in existence. First, it's created or organized outside the branch owners in country of incorporation, and the tax effect in that country of the branch is the same as if it were a subsidiary. Now, there's some limitations on this. So let's, again, dissect the pieces here. The only types of branches that count in this branch rule, not for the parent, not for the home office, but for the branch, are buying, selling, or manufacturing branches. Again, we're looking at foreign-based company sales income, so these are the relevant things. A financing branch doesn't count. The home office could be doing the financing, though, and the branch might be doing the buying, selling, or manufacturing. So the second key piece is it's created or organized outside the CFC's country. If I have a German, hold on just a minute, doing a picture here. If we have a German sub that has an Ireland manufacturing branch, then we're squarely within that fact pattern for the branch rules. The third key part is that the tax effect of the branch in the CFC's country, in that example in Germany, is the same as if it were a subsidiary. And by the way, I used Germany for a reason. Germany, France, and a couple of other European countries, and a lot of Asian countries say income of a branch is not taxed until it's sent back to the home office. And you say, well, wait a minute. I mean, they're doing stuff all the time. You could effectively do that. Well, these civil law countries have these very formalistic rules as to when the branch is remitting profits to the home country. It's almost as if it were a separate subsidiary and had to declare a dividend. So tax effect is the same as if it were a subsidiary, with a limitation. Just because you have a branch and just because it's treated as a subsidiary doesn't mean this branch rule kicks in. There has to be tax savings as a result of the branch, not U.S. tax savings, foreign tax savings. I intentionally picked my branch example of Germany and Ireland many years ago when the German effective tax rate was in the high 30 some odd percent and Ireland was 10%. Well, it's still a big differential. Germany's tax rate is in the low 30s now, and Ireland is 12.5%. So we meet this test that the tax rate on the branch, Ireland in this case, is less than 90% of and 5 percentage points less than the tax rate of the home office of the CFC or Germany. So in this Ireland-Germany scenario, we've got a rate differential of nearly 20%, regardless of what part of Germany. So the branch rule would apply in this particular case. Now, what's the effect of the branch rule? Well, the effect is to treat excuse me, the branch as a separate subsidiary, and by doing so, there may be these deemed foreign-based company sales income transactions. Let's say Ireland is manufacturing the goods and then Germany is selling the goods. So Germany is buying goods from Ireland and selling them. And we have a related party transaction there as a result of this sale from Ireland to Germany. Even though that may not be a sale for the local law, and it's certainly not a sale for U.S. law, it's deemed to be a sale under the Subpart F rules. So if we have this branch rule applying, we may find we have a lot more Subpart F income than we thought we did. Now, I've noticed that in my notes that I've handed out, there are 2 typographical errors, and I'll revise those and repost the speaking notes after we're off tonight. Okay, so let's recap foreign-based company sales income. We'll go back to that slide. Foreign-based company sales income is income from buying goods from somebody and selling them to a related party, or buying from a related party and selling to somebody, where the goods are both originate and are destined outside the CFC's country. Here we're talking about property. I've been using the word goods, but the regulations say property. The code says property. Property can include things like software. In an earlier session, I mentioned the 861 regulations on software that treat sales related or income related to software as one of three kinds: either sale of an item of property, or royalties, or fees for services, depending on what's being sold and how it's being sold. Sales of software that are treated as sales of an item of property fall under this foreign-based company sales income rule, or potentially fall under this rule. So property here could be both tangible or intangible property. Now, before we depart from this, I'd like to revisit one thing that I just noticed I missed on the examples of what's excluded. One of the tests is a 20% conversion cost test. It says if the cost of converting property, or if certain costs of converting property exceed 20% of the total costs or total basis of that property, then the property is considered to have been manufactured by the CFC and not foreign-based company sales income. Years ago, I worked for a drilling company, and one of the things that we regularly used was offshore drilling rigs that floated around the world and moved from country to country. We wanted to sell one of them, and it was going to be at a very substantial gain because the thing was almost fully depreciated. And it was going to be about a $25 million gain. This is back in the 80s when $25 million was some real money. And I looked at what how we could get out of that being Subpart F income. And you'd say, well, why would a drilling rig be Subpart F income? Well, again, it's property acquired from a related party and sold to a related party, and it's from and to someplace other than the CFC's country. Well, we'd originally acquired this rig from a related party. So it was looking, and the related party was nowhere near where the rig was going to be used. So it was looking like Subpart F income till I looked very closely at the basis of the rig. Over the years, we'd put a lot of labor and materials into improving that rig. And this 20% conversion cost test applied because the labor that we had capitalized as part of improving that rig exceeded 20% of the basis of the rig. So lo and behold, this drilling rig that we thought was going to produce Subpart F income didn't, because we, the drilling company, were considered to have manufactured it. So don't take these things completely at face value. There are ways you can manipulate the Subpart F rules to your client's advantage. So this brings us to the next prong of Subpart F income, foreign-based company services income. Just like foreign-based company sales income, it has to involve a related party and doing things outside the CFC's country. These are the two key pieces of both foreign-based company sales income and foreign-based company services income. So the services income is income from performance of services for or on behalf of a related party outside the CFC's country of incorporation. Several things are included in here that you might think, oh, you know, that's not really on behalf of. And it's those things that get included that can trip you up. So let's go through some of these pieces a little bit at a time. If we have a CFC that performs services for a related party, that's really easy to spot. If they're doing it within their own country, then it's not a problem. It's not Subpart F income. But if they're doing it in some other country, then it is Subpart F income. The harder to spot one is the on behalf of a related party. What do we mean on behalf of? Well, quite a few different things, it turns out. The obvious one is U.S. parent company contracts with contracts with a third party to do some construction, to build a dam, and subs out a lot of the work to its Bermuda subsidiary. That's going to be Subpart F income, unless the dam's in Bermuda, which is pretty unlikely. So subbing out the work from one related company to another is clearly on behalf of. But there are several other things that it could be. First is material condition services. If I sell some machinery and tell my customer, in order to buy this machine, you have to sign a contract for maintenance, and the maintenance is going to be conducted by my Bermuda subsidiary. Well, that is a material condition of the sale. So that income that the Bermuda sub is getting cash from directly from an unrelated party, but it's getting those as a material condition for something that the related party was doing. The second key thing, and this is the one that trips a lot of people up the most, is substantial assistance. If I've got a subsidiary that does not have the capability on its own of performing those services, then somebody else in the group has to come up with a way to do it. And if the things that somebody else in the group does for the subsidiary are substantial in relation to whatever services are being performed, then the income from those services is Subpart F. I'll give you an example on substantial assistance. Let's say I have an engineering subsidiary in Switzerland, and it employs 100 engineers. And it contracts, I contract to do some construction work. I'm sorry, let's start that one over. I've got a subsidiary in Switzerland with 100 engineers. It contracts to do a big engineering project in Africa. And that engineering project is going to require the services of 200 engineers. But it only has 100. So it gets employees on loan from the U.S. company. That's Subpart F income. The Swiss sub has Subpart F income. Or it simply contracts out that engineering to a German affiliate. That's also Subpart F income. Now, there are some things excluded from substantial assistance. Financing is not considered substantial assistance in any circumstances, but performance of services usually is. And I encourage you to read the regulations to kind of wade through all of these things. Now, there is an exclusion. The services, any services connected with the sale of the CFC's own products are not considered to be foreign-based company services income, no matter where they're performed or no matter who's involved with it. So if my German subsidiary manufactures machines and sells in Germany and sells those machines to my Hong Kong affiliate who sells them to customers in China, and my German company enters into a service contract with that customer in China, then that's not Subpart F income because the German company made those products. There are a few other twists here that we need to go through. First, the mere fact that the parent company guarantees that the subsidiary will fulfill its contracts does not create Subpart F income. That's really a good thing from a business standpoint because, you know, the customer may not want to contract with some small subsidiary that just happens to have the right manpower. And it's going to insist on the parent guaranteeing performance, even though the parent has no other connection with that particular contract. So a bare guarantee does not create Subpart F income. This foreign-based company services income back up a step before I cover this. Let's go back to the substantial assistance. This is what we're going to be talking about here. A limitation on what's included in substantial assistance. So where the related party is providing material assistance, for it to be Subpart F, either the assistance must be for essential elements of the CFC's services, that engineering contract that I mentioned, or more than 50% of the cost of the services. So these are the two key exclusions here. Parent guarantee doesn't do anything, and a definition of what is substantial. So as you can see, foreign-based company services income is conceptually not that difficult. Everything's in the details, though. So we really have to understand the operations to understand whether we have foreign-based company services income. And we need to understand the operations to know whether we have foreign-based company sales income. At this juncture, I'd like to speak a little bit without a slide on the impact of disregarded entities. I'm going to go back to the foreign-based company sales income. If we have a disregarded entity, it's treated as simply part of the owner. So if the owner of that disregarded entity is doing buying or selling, and the disregarded entity is doing the manufacturing, it's as if they were one entity. And we're back to this example. If my Ireland subsidiary, oops, Sorry about that. If my Ireland subsidiary were merely a branch, let me start that one again. If my Ireland operation were a disregarded entity rather than a branch, we would still be in the same position as in this example that I used earlier. That we have the Ireland disregarded entity and the German sub together involved in something that generates Subpart F income. Remember, with a disregarded entity, the activities, income, deductions, and employees of the disregarded entity are treated as those of the owner of the entity. So as you can see, the disregarded entity could throw you squarely into the branch rule, which effectively throws you back out of it being treated for Subpart F as a disregarded entity. So the use of disregarded entity subsidiaries in Subpart F has very limited application. It may be very useful in the foreign personal holding company area, but almost useless in the sales and services income area. Oops. One thing I want to talk about very briefly, and it will be in the video that that should be coming out either tonight or and hopefully tonight with an improved version this time next week, is the high tax kickout for Subpart F. We talked about high tax kickout in the passive income rules and characterizing the income as high tax to recharacterize it as general limitation instead of passive. The Subpart F version of that rule works very much the same, with one key difference. I'm going to say two key differences, but one of which is often irrelevant. First, instead of 100% of the U.S. corporate tax rate for high tax kickout under the passive activity rules, the passive income rules, the Subpart F rule is 90% of the top corporate tax rate. The second aspect of difference in the basketizing versus Subpart F is the definition of an item of income. And I'll discuss that a fair amount in the video. The categorizations of things as items are much broader in Subpart F. So there's more thrown in together before we make this comparison of effective tax rates. The basic mechanism of the comparison is just the same. So with that, I think we're at the Q&A part of tonight's webinar, and I'm open for questions, verbally or through the chat. And before any questions, our video conference call this evening is going to be on the project. Several of us spoke on Saturday about the project, and we're going to talk about that tonight at 7:30. So, I'll explain a bit more about what's going on, and then it'll be open for questions solely about the project. So questions on this part or the introduction to Subpart F? Okay, it looks like we don't have any questions. As always, you can reach me by phone or email with any questions you've got, and we'll reconvene on our video call at 7:30. That's in about 18 minutes. See you then.